Warren Buffett is the most successful investor of all time, and people admire him not just for his success at allocating capital, but for doing it with the highest levels of integrity. This video is a detailed yet quick summary of his investing methods. I have nothing to sell, I just want this information to be readily available and accurate for people like you. Let's get started. Number 1. What is a stock? Before we dive into how to invest in them, it's important to understand what a stock even is. A stock is a partial ownership interest in a business. Most people that don't know about stocks or dabble speculating in the markets look at all these companies for sale and see them like NASCAR race cars labeled with business names. There's the Home Depot car, and the McDonald's car, and the Lowe's car, and maybe this one will win the next race, and this car is going to slow down for the next 3 months. And this one's recommended by a handful of analysts. This is not the way to think about stocks. This is simply speculation. Don't focus on what the stock is doing. Focus on what the business it represents is doing long term.
Warren, what do you do that's different than 90% of the money managers who are in the market?
Certainly most of the professional investors focus on what the stock is likely to do in the next year or two, and they have all kinds of arcane methods of approaching that, but they do not really think of themselves as owning a piece of a business. The real test of whether you're investing from a value standpoint or not is whether you care whether the stock market is open tomorrow. If you're making a good investment in a security, it shouldn't bother you if they close down the stock market for 5 years. All the ticker tells me is the price. And I can look at the price occasionally to see whether the price is outlandishly cheap or outlandishly high. But prices don't tell me anything about a business. Business figures themselves tell me something about a business, but the price of a stock doesn't tell me anything about a business. I would rather value a stock or a business first and not even know the price, so that I'm not influenced by the price in establishing my valuation, and then look at the price later to see whether it's way out of line with what my value is.
Because stocks are so liquid and can be bought and sold in the same minute, people think of them differently compared to buying apartment buildings or farms or entire businesses. Probably the single biggest mistake beginners make is seeing a stock price as the current value of the stock. This price is the current market value, not the intrinsic value, which is future earnings discounted to the present. In other words, what is the current value of the future cash flow this business can generate?
Yes. I have an old-fashioned belief that I should expect to make money in things that I understand. And when I say understand, I don't mean understand, what the product does or anything like that. I mean understand what the economics of the business are likely to look like 10 years from now or 20 years from now. I know, in general, what the economics of, say, Wrigley chewing gum will look like 10 years from now. The internet isn't going to change the way people chew gum. It isn't going to change which gum they chew. If you own the chewing gum market in a big way, and you've got Double Mint and Spearmint and Juicy Fruit, those brands will be there 10 years from now. So I can't pinpoint exactly what the numbers are going to look like on Wrigley, but I'm not going to be way off if I try to look forward on something like that. Evaluating that company is within what I call my circle of competence. I understand what they do, I understand the economics of it, I understand the competitive aspects of the business. There can be all kinds of companies that have wonderful futures, but I don't know which ones they are.
The stock price is just the current offered price for Mr. Market to sell or the cost to buy more. If you like the business, buy some, and the stock price goes down, now you can buy even more at an even better price than before. It's like a sale at a supermarket. If eggs go on sale at the supermarket, you don't assume they're lowering the price because the eggs are now rotten and broken. Rather, it's an even better deal than usual. Don't try to time the market, especially trying to buy and sell short-term for small gains. You can't keep leaving and entering the market for long-term gains. The market doesn't look like this. It looks like this over time. So if you sell here and buy here, you just missed out on gains or even worse, lost money. It's not about timing the market, but rather time in the market. Buffett didn't make all of this money timing the market. He bought shares in good companies he could understand and held them for decades as they did even better. The main idea of value investing is basically to buy a group of solid businesses, oftentimes ones that pay dividends, and hold on to them for as long as we still have faith in the business and its leadership. While these businesses are being held, the company is either reinvesting its profits back into itself to expand the business even more, or paying them out to the owners, you, the shareholders. With that, you'll reinvest them back in yourself, into the same stock if it's selling at an attractive price, or finding another company if that looks better. The reinvested dividends have a snowball effect. A small snowball rolled down a hill can collect more and more snow as it rolls, and by the time it gets to the bottom of a hill, it can destroy a whole house. This is called compound interest. If you know anything about exponential numbers, it can turn very small amounts of capital into massive amounts, especially over extended periods of time.
Einstein is reputed to have said that compound interest is the eighth wonder of the world or something like that. And it goes back to that story you probably learned when you were in grade school where somebody did something for the king and the king said, "What can I do for you?" And he said, "Well, let's take a chessboard and put one kernel of wheat on the first square and then double it on the second and double it on the third." And the king readily agreed to it. And by the time he figured out what 2 to the 64th amounted to, he was giving away the entire kingdom. So it's a pretty simple concept, but over time, it accomplishes extraordinary things.
Number 2, how do I know what stocks or businesses to buy? The most important thing is to know what kinds of businesses you can understand. Buffett calls this his circle of competence. Basically, it's a lot easier to see out into the future what the Coca-Cola company is going to look like 30 years out into the future compared to Tesla or Netflix or Facebook or IBM. Instead, in the 1990s, when everyone was dumping money into internet companies, many of which eventually crashed to zero, Buffett was invested in soda, shaving razors, car insurance, ice cream, and furniture. These are very simple businesses that are easy to project into the future, as opposed to the internet companies which were outside of his circle of competence, so he simply avoided them, saving Berkshire billions in potential losses. Try to find companies you can understand and can imagine what they look like far out into the future. Don't focus on what the stock is going to do in the next year, focus on where the company is going to be. How much can this business expand? How will the internet take away our business? Who are the competitors? How capable are they? Do we have a moat, a loyal base of customers that will return to us constantly because they know we have a strong brand with a good product and great customer service? We need to have faith in the leadership of the company. What does the management believe in? Are they trustworthy? Do they cut corners? Have they had lawsuits for accounting practices? Has the management stayed there long term or are they new? Thankfully, we live in the 21st century, so you can watch interviews of CEOs at any time of the day going back decades to see what kind of a person is leading the company you're looking at. Faith in the leadership and faith in the company's ability to keep what it has and gain more is vital for long-term success. By far the most important part of this is looking at business figures. What is the value of the assets the company has? Does it have an excellent and constant return in its revenue? How much debt do we have? Is the debt load sustainable, or will we have to struggle to pay it off? These are the kinds of things a value investor thinks about, not if the stock is going to go up next week. Investment done right is boring. A lot of people think investing looks like this, but it actually looks like this.
Let's get more on what this deal could mean for Microsoft with Brian Jeffries, Jared Weisfeld. Jared, great to speak with you. You also think this deal makes a whole lot of sense. In terms of the synergies across the consumer business, what do you think this deal could enhance for Microsoft?
I think at the end, just because you can doesn't mean you have to. Just because you can buy stocks and sell them 3 minutes later doesn't mean you're obligated to. If you have a bunch of cash, resist the itch to spend it. If you don't see something that is so obviously a great purchase, you don't need to carry it out 5 decimal points to tell. This includes the reinvested dividends mentioned earlier. If stocks look expensive, or if you don't see something that meets this criteria, you can just allow the cash to build up until you see something that does. This can take years, but it's better than surrendering to FOMO, or the fear of missing out, and losing big when a fad or a bubble ends. The best way to tell if stocks are expensive or not as a whole is by looking at what's called the Buffett indicator. Essentially, this is putting the stock market on top of the gross domestic product, or GDP, of the country you're in. Of course, this is the United States. Anytime these two lines don't meet exactly, the market is either slightly cheap or slightly more expensive than what the underlying businesses are worth as a whole. This doesn't mean that every single company is selling at a low or high price, but it's been said to be the best indicator in general to tell if things are cheap or expensive. It's worth checking on every few months to see how they align. As you can see, stocks were the most attractively priced, like a sale in the supermarket, during the dot-com bust and the 2008 financial crisis. And of course, the stock market crash of 2020 a few months ago was a fantastic opportunity for people to buy. But once again, while this is an ideal time for buying stocks in general, it's not the best time for every stock individually per se. Look at Apple. If you timed the exact bottom of Apple's stock in the 2020 crash, you would still be paying more than what it was selling for even a few months before under normal circumstances. This is why it's important to pay attention to the business itself, not the market by itself or the stock by itself.
Over the years, you've generally been reluctant to frame a big cosmic position on the stock market.
I've done it about 5 times.
I know, but I think last spring, if I'm remembering correctly, and correct me if I'm not, you said that stocks were neither greatly expensive or really cheap.
Right.
What would you say now about stocks? And in answer, you might also mention what people are now calling the Buffett standard. I didn't even know that. A statistical comparison that Fortune has used and promoted over the years, and tell us how things rank there.
Well, I did use in a talk I gave 15 years ago at Sun Valley and got reprinted in Fortune, a standard of total market capitalization to GDP. And that I used that because it showed at that time how extreme things had gotten. I think they'd gone from
Really high.
Yeah, they'd gotten from 40% of GDP, which had been kind of standard over the years, they'd gotten up to like 170% or something. So it wasn't designed to be a fine-tuning type of valuation, but it showed things had really changed in a big way. A very high percentage of the time, stocks are in what I call a zone of reasonableness. This is not something, we all know that pi is 3.14159, and little kids can sometimes give it out to hundreds of decimal places. But the stock market's not like that. There's a range of reasonableness, and most of the time throughout my lifetime, it's sold in the range of reasonableness. That range changes over time as earnings accumulate and interest rates change and all that sort of thing. There's only been about 5 times in my life, I think, that I've actually spoken out publicly to say it was outside the range in one direction or another. The most recent one being in October. I was early in October of 2008, and I said stocks were cheap, and I wrote an op-ed in the New York Times. But I'll probably have some chance, once every 5 or 10 years to make a definitive statement. There is a big zone of reasonableness. Anybody thinks they can pinpoint it is crazy. It's not that precise. And fortunately, you don't need to. If you buy good businesses at reasonable prices and hold them, you're going to make a lot of money. And that's true of stocks as a group. It's true of individual companies.
I hope this video helped you out, and if it did, don't forget to hit the like button, and I'll see you all next time. Thanks for watching.